Hello, and welcome to our end of August update from the Wealthy Doctor Institute. Physicians leading physicians through finance. We work with physicians and other busy professionals who are not happy with their current investment strategy. We help them get this part of their lives handled, so they feel empowered and in control. I'm David Ye, and in my book, The Busy Doctor's Investment Guide, I show you just a few ways where just a few adjustments each year can help build and protect wealth. Although the strategies in this book are easy to calculate each month, for those of you who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So for this month's video, we'll go over the usual Busy Doctor's update of the month, then we'll go through the topic of the month, then we'll go review our systems, starting with our 20-month moving average system, review our MRI system, remind ourselves of the rules for 25% stop loss system, and then monitor the free sector surfer strategy that comes with any sector surfer account. So a day in the life of a busy doctor. This summer has certainly been challenging. This whole summer, we've been extremely short-staffed at the University of Illinois Chicago, including the fact that our chief of nuclear medicine quit in May to go to his dream job in MD Anderson, so we've been looking for candidates to fill the position. Meanwhile, I've been filling in the position, and oh my god, I'm so glad that I'm not doing this full-time anymore. I mean, don't get me wrong, it's been great. It's been fun teaching the residents, the medical students, and at least when I'm working, I'm only dealing with a daily grind. I'm not dealing with all these intra-departmental or interdepartmental politics, billing, and issues trying to grow and scope the department in light of new regulations and protocols coming down the pike. But man, supposedly we have this new candidate who's been offered a position. He's being credentialed by the hospital right now. It takes some time, as you know, and I hope he'll be starting as early as October 1st. Then I can get back to dedicating myself more to these investing educational pieces for you, while at the same time finally again being able to spend more time with my family. Even though I semi-retired 4 years ago, life continues to be busy. But despite all the busyness, I still easily place the trades I indicated by my systems. They literally require mere minutes to see and execute. So the topic of the month is risk. And the reason why I choose this is because I often get this question. I want something really conservative. What do you have? Well, let's drill down that question. What do you mean by conservative? Well, something less risky. Well, that's a whole big can of worms right there. But, I guess we should address this eventually. I've talked about risk in my book. I've mentioned risk here and there in my other videos, but let's tackle this on more head-on for this video. So for risk, usually people say, well, I just don't want to lose money. But at the same time, I want to reach my goals or retirement on time. Well, it's kind of hard to do both, at least traditionally. And we have to talk tactical versus strategic. So, as physicians, we're all familiar with the informed consent procedure. Anything we do carries some kind of risk, no matter how small, and we're supposed to talk about these with our patients. And you're probably familiar with these words. The risks, benefits, alternatives, all questions, answers of patient satisfaction, blah, 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 when we make these informed consent notes. So, let me introduce the three-bucket system if you haven't already heard about this from other videos. There are several bucket systems. I take the three-bucket system as described from Tony Robbins' Money Master the Game. It's a best-selling book. If you haven't read it, it's actually very easy to read. It's a great starting point to think about these things. But strategically, we're looking at what happens when you pay yourself first. Everything in personal finance boils down to spend less than you make. And then what do you do with it? It's not what you make, but it's what you do with what you make. So when you pay yourself first, you can put into one of three buckets, or at least divide into these three buckets. Namely, bucket one is a security bucket. And this one we're using for emergencies, opportunities as they present themselves, fixed short-term goals. Meanwhile, bucket 2, you have the growth/risk bucket. And we say the risk bucket because we have to remind ourselves that investments that tend to grow tend to have risk. Now, yes, I've met a couple of people who haven't really invested outside of their businesses, and as a result, but they've been disciplined enough to at least save money in the bank account to a point where they achieve their critical capital mass. Now, that's rare, and it's extremely hard to do unless you know how to actually grow your own business. Most people in jobs, in other words, if you get a W-2, you probably have a job, not a business. Most people who just have jobs, it's very difficult for them to increase their paycheck enough to be able to fund the security bucket only and still be able to reach their big financial goals, including retirement goals. Most of us mortals have to worry about the growth risk bucket. And then, of course, there's the bucket 3, which is a dream bucket. And there's the importance of having reward in our lives. So, finance the balance of these 3 buckets. In other words, bucket 1 and 2 is how to live. Bucket number 3 is why we live. So let's talk about the risk bucket risk. I mean, what is risk? Well, if you take the Webster's dictionary definition, it's definition number 4 is saying the chance that investments, such as a stock or commodity, will lose value. Well, how do I measure risk and therefore know if something is risky? Well, this is how traditional investment advisors see risk. They trade return for risk and vice versa. And this slide is courtesy of Scott Judge from Sector Server. Thank you, Scott. We start with a data point. And this data point, this green data point, is the so-called risk-free return. In other words, if you were to stick money into a money market or invest in short-term treasury bills, that's the amount of money you would make without risk, or at least with minimal risk. I mean, everything has risk. There's always a chance of default, yada, yada. But for all practical purposes, if this is the risk-less way to invest, you only get a small amount of return. All these blue dots here represent all these different ways that you can invest. Individual stocks, mutual funds, real estate, bonds, limited partnerships, oil wells, what have you. They all carry a certain amount of risk and with expected amount of return. And supposedly, if you were to combine these available investments into some kind of portfolio, you would end up with one of these red dots, which is the efficient frontier. This is a set of all portfolios that has maximized expected return while minimizing risk to the theoretical limit. So this is the line where supposedly using traditional investing, you'll probably never do better than. If you want to improve your returns, you're automatically assuming more risk. So modern portfolios theory says portfolios cannot live in this forbidden corner. So how do you measure this risk? I mean, how do you give it a number so you can actually put it on a graph? Well, if you were to use the portfolio standard deviation, then you can use a Sharpe ratio. In other words, you take the average portfolio return minus the risk-free return, usually short-term treasury bills or money market returns, and you divide the whole spiel with the portfolio standard deviation. Based on that standard deviation, you'll get some kind of number that indicates roughly how risky or how safe your portfolio is. And obviously, the higher the number, the better. Well, the problem with the standard deviation as a measure of risk is that it's very academic. It's very easy to calculate academically, but for all practical purposes, it doesn't really jive with what our concepts of risk is. Remember Webster's definition, it's the risk of loss. So for instance, if you were to take the S&P 500 year-over-year return, some years returns are higher, some years returns are lower, and if you take this black line as an average long-term return, some years in the green, it's within one standard deviation of this long-term average return. That's supposed to be good. The yellow is 2 standard deviations above or below. Supposedly that's more risky. And then the red is when we're more than 2 standard deviations away from the long-term average. Well, here's a problem. Yes, these red zones are risky. We're losing money with these years. However, these years when it's red, we're actually making money. In fact, we're making a lot of money. We're averaging 30% here, 35% here, 27% here. No one's ever really complained that they've made too much money or complained that it was too risky when we do make too much money. So as a measure of risk, standard deviation does not truly represent real risk. In other words, risk of actually losing money. So what's an alternative? Well, if the Sharpe ratio is calculated this way, using portfolio standard deviation, there's another number called the Sortino ratio that's less well known among even money managers, and that's the portfolio average return minus the risk-free return divided by portfolio downside deviation. So just by taking into account just the downside deviation, we get a different number. Again, the larger this number, the more relatively safe it is. And here's an example. So if we were to just buy the S&P 500 index fund, in this case the VFINX or the Vanguard 500 index fund that has the most data they can find for any index fund, we can see that the Sharpe ratio is 0.47 and Sortino ratio is 2.53. Okay, well, what does this mean? Well, you can see how when compared to the actual S&P 500 index, that's in white, compared to the mutual fund, which is yellow, you can see that the relative risk comparing the mutual fund to the actual index is 109%. In other words, it's lost a little bit of money because over time, even though the Vanguard index funds are famous for having very low fees, those fees actually add up enough to cause a little bit loss or a little bit lag in your growth. Not only that, but there are also inefficiencies in the markets. Whenever index changes, for instance, the index fund is obligated to sell whichever stocks were dropped from an index and buy whatever stock was gained from an index, and that carries some slippage costs. And then trying to get the whole portfolio exactly like the index, you can approximate it sometimes, but it's not, even with a large fund, it's almost never exactly like the index. So those are several major reasons why the index fund will probably never actually match the actual index. So that's why the relative risk is 109%, but the Sharpe and Sortino ratios for the S&P 500 index is comparable. So that's a relative risk number. Let's talk about this. How do we measure risk? Well, one way is to look at the relative risk, which is defined in this example as a quarterly downside deviation, and comparing the test portfolio to the standard portfolio. So for those of you who love numbers like I do, here's the equation where we use to calculate out this quarterly downside deviation. You take the one for the test portfolio and divide it by the one for the consensus aggressive portfolio. In this case, it's the S&P 500 index, and we get a relative risk number. And for those of you who don't understand this notation, it just means that either there was market loss or we use 0. In other words, market gains aren't included in this calculation. So what do we do with this? If you take a look at the relative risk of just holding the bond fund, the long-term treasury bond fund, okay, it's less risky. It's only 61% as risky as holding stocks in the S&P 500 index. With a higher Sharpe ratio and higher Sortino ratio, meaning that for the amount of risk that you're holding, you're actually making more per unit of risk. And here you have the compounded average growth rate, which is what I call annualized return in my book. And now just to go through some of these other risk metrics here, if you take a look at the bell curve of the relative probability of any quarter gaining or losing money, the white bell curve is the S&P 500 stock index fund. the yellow is the bonds. So you can see how bonds doesn't lose as much after 8%, but then there's smaller losses. Bonds tend to have slightly more smaller losses than stocks. Likewise, bonds tends to have more smaller gains than stocks, in other words, less than 8%, but then the really big gains, less than stocks. So that's one way to interpret these bell curves. And then, of course, you have the risk-reward profile. You have stocks here, very risky, and reward here, compared to bonds, less risky with this amount of reward. Now remember, these are probabilities, so instead of using standard deviation here, we're using chance of a 15% loss year over year, which I think is a lot more intuitive than using standard deviation. And then this chart here, you can take a look at the relative drawdowns. So with the stocks, you can see how stocks can lose up to 42% here, 50-something% here, whereas the bonds barely lose 10-15% at the most over the last 29 years, and comparing relative returns on this graph. So okay, great. This is bonds compared to stocks. Overall, it makes less, but it's less risky. So how about a 50-50 portfolio where we have half in the stock mutual fund and half in the bond mutual fund? Well, in this case, our relative risk is even lower. And yet, our compounded annual growth rate is higher. It's not as high as the index itself, but it's higher than bonds. And for the amount of risk it's taking, it's actually making more than holding bonds. So that's where the Sharpe ratio and the Sortino ratio are both even higher than bonds. So this is where modern portfolio theory is trying to describe. You have a risky stock here, less risky bond here, combine the two, and you're 1 point closer to the efficient frontier. But wait a minute, there's also something here called a safety score that I'd like to talk about. Now, if you take a look at relative risk, it's comparing that to S&P 500 index. Sortino ratio is comparing risk to downward standard deviation. Relative risk also has downward standard deviation. So if you were to divide the Sortino ratio by the relative risk, then you get the relative gains per unit of risk of the underlying test portfolio, namely S&P 500 index. So in this case, this safety score, which is the Sortino ratio divided by relative risk, is 10.5. Now, just to put this in context, if we were to look at the stock-only safety score, it's only 2.3. The bonds-only safety score is 5.2. And a combined safety score of 10.5. We have made a safer combination of stocks and bonds while sacrificing relatively little gains. So far, so good, right? So, of course, I always ask the question, can we do better? And of course we can. Look at this strategy that I keep showing you month after month, where all we're doing is using the StormGuard armor feature of sector surfers, switching between stocks and bonds when stocks are relatively safe, when stocks are relatively dangerous, when bonds. We're making maybe 1.5 trades per year, and as a result, our relative risk is even lower. Our compound annual growth rate is even higher. In fact, it's even higher than stock itself. The Sharpe ratio is above 1, Sortino ratio is way up there, and the safety score is 18. Let's look at the bell curve. We've pretty much cut down on these larger losses. We still have some frequency of relatively smaller losses, but then we have more smaller gains as well, and we still participate in the larger gains. So with a bell curve like this, we get a growth curve that looks more robust, as these numbers indicate. So if you take a look at the risk-reward curve here, here's stocks with this amount of risk giving this amount of return. And now we're playing in the forbidden corner, where the chance of a 15% loss year over year is less than 1%. If you take a look at the corresponding drawdown curves, we have a portfolio or system here now that is even less so-called volatile, and here are the relative return graphs. So by several different measures, doing this one simple actively managed system that only trades 1.5 times per year, we've been able to reduce risk and increase returns. In fact, what we're doing is, because all we're doing is mitigating risk, we let the returns take care of themselves. Okay, so let's look at the example free strategy that they give us at Sector Surfer when you sign up. I've said before in my other videos that it's not a great portfolio, and here's why. The safety score is only 8.5. Sure, the relative risk is low. The compound annual growth rate is relatively high. It's higher than the individual components, especially the S&P 500 index. Sharpe ratio, Sortino ratio, they're kind of high. But with one example before I showed was even higher. So here's what that modern portfolio theory graph looks like. All these different components. If you combine them into this one system that trades maybe 5 times per year, we can decrease the risk while increasing the return. In this case, you have a roughly 5% chance of losing more than 15% in any 1 year. And if you take a look at this bell curve, the amount of risk that's actually mitigated isn't that great. But then again, the amount of gain that you actually make, maybe a smidgen in the lower ends, maybe a smidgen in the higher ends. And then the drawdown curves, we can do better. But then again, this is a free example strategy, so it's a good strategy to learn from. And if this is good enough for you, they tell you exactly which funds are in, and we'll have a more further discussion on this later on in this video. So to summarize, when we talk about risk, I often hear, I'm conservative, I'll just buy bonds, or I'll just stick cash under my mattress. Well, is it possible to be safer than bonds? I hear this all the time, like bonds are supposed to be the safest thing on the planet, and it's just not true. Nothing in the investment or risk bucket is without risk, even bonds. Heck, even cash. I mean, even in medicine, we know even the smallest of interventions carry some kind of risk. Even something as simple as aspirin, unless properly monitored, can result in life-threatening GI bleeding. Well, same with investing. Even something as basic as bonds have their own risks. We haven't even talked about interest rate risk or counterparty risk. But if you take a look at just the market risk of bonds, we can measure that and compare that to stocks and portfolios containing stocks and bonds, and compare them to systems that use stocks and bonds. We can compare apples to apples using those risk measurement parameters. And I just showed you several ways in which we can mitigate risk and improve returns. In other words, risk that's safer than bonds. And must we settle for decreased average returns to decrease the chance of significant loss? In other words, traditional money managers say, yeah, we have to trade off between risk and return. And yet, I've shown you that risk and return are not necessarily inversely correlated. In fact, by systematically and algorithmically decreasing risk, we let the returns take care of themselves. But such algorithmic systems need to be consistently executed, even if only a couple of times per year. In other words, this is something that I have espoused in other videos already. Have a system, stick to your system, actually execute your system. If you have a system but you don't follow it, you don't have a system. Alright, so now that that's out of the way, let's review our systems for this month. So remember, our systems objectively look at the footprints of every trader and investor in the markets and let the markets tell us what to do. We're not trying to pick tops or bottoms. We're not trying to forecast changes in the markets. We're trying to detect when trends are already established relatively early and then capitalizing on that. So first system, using 20-month simple moving average system, abbreviated 20-month SMA. Here are the rules. If the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay invested in an index fund. Otherwise, get out. Now, the 20-month moving averages are safety belt. It only works if we actually watch it and use it every month. So here's where we are right now. The S&P 500 Index Fund was $228.99 at the end of the month, and the moving average was $204.10. So the moving average went up a little bit. The stock itself kind of went flat. And so as a result, our cushion is now down to 12.2%, which means that if you can wiggle around for around 12.2%, we're still relatively safe. It's not until it closes below 204.10 by the end of next month where we signal that there's a major market change going on. So the 20-month moving average observations so far, the 20-month moving average indicator continues to signal relative safety in the U.S. stock market. So while the S&P 500 index was somewhat flat this past month, the 20-month moving average has increased to a point where now the safety cushion has decreased, even though both have increased in total value. Now remember, this system is not designed to catch peaks. Markets must fall enough for us to detect a trend. This is how we mitigate risk with this system. And so here's Sector Server StormGuard Armor, which is the more sophisticated version of the 20-month moving average filter. This is a third-order filter compared to first-order filter. And according to StormGuard Armor, we've been in the S&P 500 index for months now. And here's the StormGuard Armor indicator, still in a positive territory. So the next system is the Monthly Rotation Investment System, abbreviated through MRI. Here are the rules. Every month, rank using dividend-corrected data the three mutual funds: S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. Sell the bottom 25% of your portfolio and buy the top fund. So here's how it works this month. If you take a look at last month's data, this month's data, the S&P 500 Index only grew 0.3%, the Inverse Fund lost 0.2%, but the emerging markets zoomed up 3%, a whole order of magnitude more than the S&P 500 Index. So here's a graphic representation of what's been going on. The S&P 500 Index and Inverse Fund have been relatively, while the S&P 500 Index and the emerging markets kind of dipped up until August 10. The U.S. market stayed relatively flat while the emerging markets took off. So if you look at a current model, last month we were 100% in the Emerging Markets Fund. Because the system still indicates rotating into the Emerging Markets Fund, we're already 100% in, so we don't have to make any changes this month either. So here's the Sector Server rotation model of the MRI funds. I mentioned before that even though this particular system seems to perform better than the book version that I've been calculating for you every month, the safety score here is only 3.1. So yes, it's safer than the S&P 500 index, but there are safer systems to use besides this. I use this for illustration purposes. So observations of the month. The markets continue to be flat until down until August 10. This is when the U.S. stock market and the emerging markets diverged, with the clear winner being the emerging markets. Sector Server also continues to be in the emerging markets, but remember, Sector Server uses a different algorithm. Don't mix up the systems. And remember, just because two different systems agree on which mutual fund to be in, doesn't make this a sure thing. Markets can change, and if the markets were to change within the very near future, each system will react differently and give you different exit times. Watch your system. So next system is the 25% trailing stop loss system. The rules: if you really want to buy a stock, limit your risk to just 1% of your portfolio or trading account. Buy using only 4% of your trading account that idiosyncratic stock of yours. Immediately enter a 25% trailing stop loss order. So if the stock goes up by 33%, buy another block of stock using another 4% of your account and update trailing stop loss order to reflect the increased number of shares. Repeat until stopped out. Now, I can't tell you if you had a signal generated because of this 25% trailing stop loss order, because every stock is different. round at least once per week on this so you don't miss a major stop. Our next system, just like how we all have our own trailing stop loss systems, if you want to use individual stocks, we can all have our own sector server system depending on, for instance, which mutual funds are available through your 401k plan, etc. Now remember, the sector server system is an improvement on classical pie chart investing in that it has two main tools. It uses Stormguard Armor, which is a way of sector server to figure out whether or not we're relatively safe or dangerous to be in stocks. And once we determine whether or not we're in safe zone or danger zone, if we're in a safe zone, we rotate among which of the stock funds we choose is actually dominating at the time and just buy that one. Meanwhile, if it's dangerous for stocks, there's a separate bear market strategy that we use to see which bear market fund is actually doing the best, and we rotate into that. Remember, Sector Server also has explanatory articles and videos on how to construct your own Sector Server strategies. Go ahead and take a look if you haven't already built your own portfolios. So remember, if a Sector Server strategy is set properly, you will get a signal through email or text. But, especially if you have several strategies, I would log on periodically, for instance once a week, just to make sure you're not missing any signals. So, just to analyze this month's model free strategy, we're still relatively safe for stocks, and the dominant stock fund tends to be the Fidelity Worldwide Fund. Now remember, one of the weaknesses of this free strategy is that it's not rotating among pure stock funds. It has a bond fund in the bull market strategy, which kind of defeats the purpose of optimizing a bull market strategy. So in summary, remember, these are all different systems. Don't mix them up or mix them together. We've gone over the 20-month moving average system, the monthly rotation investment system, dealing with stock tips using a 25% trailing stop loss system, and monitoring your sector server strategies. So keep those questions coming. I know I talk to several of you personally each month and realize that for some of you, these video updates are not enough, especially if you're still unhappy with the current investment strategy or lack of strategy. I'm going to offer a complimentary investment wellness checkup and breakthrough session for you, just you and me. Ask all the questions you want, no matter how seemingly basic or clueless you think you are. In our checkup and breakthrough session, we'll together create a sense of clarity about your financial future you really want, the reasons you're investing to begin with, and how to get you there. Discuss investing building blocks that are more specific for your situation, determine what has stopped you in the past from getting what you want now, identify what are the most important steps you need to take now to get to your investing and financial goals, and then complete our consultation with the excitement of knowing exactly what to do next to create that road to the future you really want. Think CME, only a topic is financial and tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had a financial cancer or a blind spot you didn't know about, wouldn't you rather at least know so you can deal with it before a problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely